Welcome back to another episode of the Planning Perspectives podcast. I'm Kate Duffy, Senior Financial Advisor, Bryn Mawr Trust Advisors, here with Jamie Hopkins, Chief Wealth Officer at WSFS. Welcome, Jamie, and thanks for being here.
It's great to see you again, Kate. We're back on the show. We're going to talk about one of my favorite topics, which is really Roth IRAs and Roth planning. And what does that mean? I am going to do a little sidebar, but I wrote a book a long time ago, and one of the people who gave it a negative review online was like, this guy talked about Roths way too much. And I actually thought if I ever did a second edition of that book, I was going to take that negative, like 1 out of 5 stars, and put it up there and be like, this guy talks about Roths too much, because I love it. And it was purposeful. Like, it wasn't by accident. So it was a correct assessment of the writing.
Well, I think that our listeners are going to learn a lot today because this is a very hot topic. And today we are framing Roths as a timing tool.
Yeah, it really is. It's about figuring out when. For a lot of people, Roths will make sense at some point in their life. It's very, very rare that a Roth would never make sense for a saver. But we got to go over the basics. We got to understand, like, what's really driving the planning around this. Like, our show is called The Planning Perspective. So we're going to give you my perspective and your perspective, I think, on Roths. Where do they go? So let's just start with one really big frame up. When people hear Roth IRA, that's not an investment. It's an investment vehicle. It's going to hold something that you save. Then you're going to pick your investments inside of it. But Roths are after-tax money versus a traditional IRA, or what most people have experience with, their 401k. Typically, these are pre-tax money, which means you're not paying taxes on the money that's going in a pre-tax money situation. So if you want to put $5,000 in, $5,000 goes into a traditional IRA, and no taxes are paid at the time that you put money in, versus a Roth. Roth, you say, I'm going to put $5,000 in. But if you're taking it directly from, your work, you're going to pay taxes first at 20% and then put the rest into the Roth. So that's a really big difference. Is it's after-tax money in a Roth versus pre-tax money in a traditional 401k or traditional IRA account.
And we frame this as a planning tool because it's how we have control over when we're going to pay taxes. So let's again go back to the basics. Let's talk about who can open a Roth IRA, an individual retirement account, or IRA. We hear all of those things. And what are the limitations around it? Who should be, like, how do we think about that?
Yeah, well, to solve the IRA versus IRA debate, while I bounce back and forth between both, there was actually somebody in the government at the time it was named after. So it was actually IRA, was what it was designed to be pronounced as for one of the people who worked on the design of it. So it was supposed to be IRA, but that's a long time ago now, and it's developed a lot. But who can contribute? One of the first things is you have to have income. So like earned income, not just investment income. You have got to be out there with a job. Now, we'll get to a little bit of this later on about kids. There's some wrinkles in that one, but really you need earned income. That's step one. The next step is, do you make too much money? There are phase out limitations for Roth IRAs. So in 2026, you can put $7,500 into a Roth IRA with an additional $1,100 catch-up provision, which really just means an extra amount you can contribute if you're age 50 or over and at least have that much income. So you'd need $8,600 of income if you wanted to fund it as an individual with $8,600. But I mentioned those phase out ranges. Now, these move every year. They're inflation adjusted ranges. So for a single filer, meaning single person filing their taxes, $153,000 to $168,000 of modified adjusted gross income. That's the range. So if you make $200,000 and you're a single filer, you cannot make a direct contribution to a Roth IRA. Now, for married filing jointly, that range is $242,000 to $252,000 in 2026. So meaning you make $300,000 of modified adjusted gross income. As a couple, you cannot make a direct contribution. So these are the basic rules, right? So we have to be working. We've got to have earned income, and we have to have our income levels below these thresholds to make, and I keep using this direct
Mhm.
contribution. We'll maybe get to this little backdoor one, but
Right.
that's pretty far along in the planning. But that's the general idea. And then we're thinking about what are our taxes? Are we going to put money in here? And when is it the right time to do that?
Okay. So you have the income limitations, you have the annual limit that you can contribute, and this is after tax. So you pay taxes on the money, it goes into the Roth account, and then if you follow all the rules, it will be tax free when you take it out. You sit, you let it grow, the earnings inside of it, any of the gains you make at retirement or after age 59 and a half come out tax free. People love that. Tax free.
Yeah, and it really is a powerful planning tool because you get to invest in markets and high growth assets inside of Roth if you want. And because you already paid taxes on your contributions beforehand, the government's created rules that allows us to grow, as you said, tax deferred. And then as long as we hit 5 years of the account being opening and what we call a triggering event, for most people, it's age 59 and a half. There are some other ones out there, first time home buying expenses and up to $10,000. But really, we're talking about you get past age 59 and a half, and then your contributions and your earnings come out income tax free. And they really just don't show up on your income at all, which allows you to keep things like Social Security taxes
Mhm.
down, Medicare premiums down, and you can control your tax brackets more in retirement.
Right. So let's quickly contrast that with a traditional IRA. That is when you have the same contribution limit
Mhm.
in a given year. You put pre tax money in that. So you get the tax break up front, and then that money grows tax deferred. So when you go to take that out in retirement, the earnings and the growth are taxed.
Yes, so they become taxable at that point. Now, here's the thing, and I will use a quick math example, and I'll try to do it in my head for everybody, and hopefully you can follow along. But the difference here, the big decision for most people is should I pay taxes today
Mhm.
or pay them in the future? If tax rates remain the same, you end up with the exact same amount of money that you can spend after tax in both situations. So let's just look at it this way. I'm going to walk you through an individual, and I'm going to keep the numbers very simple here. They do a traditional IRA, and they put $100,000 into it over, let's just say, their 20-year working career, and they put $100,000 into it. And for simplicity, I'm just not going to have this grow. It's just going to be $100,000 because otherwise I'll mess up the math. And let's just say then you go to the future and they owe 25 percent in taxes. At that point, right, they would pay 25% on the 100,000 when they take all the money out, and they would end up with $75,000. That part, I can do the math, works out fine. We remove 25,000, that goes to the government. Now, on the flip side, let's say we did a Roth IRA and we had $100,000 that we were going to save, same amount of money. We didn't magically end up with more money, so we had 100,000 and we paid the taxes up front. So 25% means we put $75,000 into the Roth. And then we moved forward, markets went up and down, but for whatever reason, we ended up flat again. Well, we'd have $75,000 there. In both scenarios, if tax rates remained 25%, we would end up with the exact same amount of money. Now, here's the difference. If tax rates go down in the future, we would want to defer taxes to pay lower tax rates. If tax rates are lower today, we'd want to pay tax rates today. The simplest way I always use this is an extreme example, and it's not real life. But let's just say you had zero taxes today. Would you want to pay taxes today or wait in the future till you had 100% taxes? Well, it's really easy. You would obviously rather pay zero than 100. Now that's the extreme example. That's not really true. Like we're not going to live in a world where we have 100% taxation.
Right.
But you might be in years where you do have close to zero taxes, especially early on in your career when you're only making maybe $10,000. when you're in high school, you're really not paying much in taxes. So it's a great time to pay taxes today and do a Roth versus wait till later when you might be in the 22% tax bracket. So that becomes the main crux of Roths is should we pay taxes today or in the future?
Mhm. Because it does give optionality and flexibility. And that is part of planning for retirement. It's not just about how much you save, it's being tax smart about it and making those good decisions year by year because a Roth decision is not a set it and forget it. It's
Mhm.
not that you do it every year because we've talked about there are different instances, situations that could come up that might prevent you from making a Roth contribution in a given year.
Yeah, and Roths are mostly about that. It's about a particular year. And that's what I always try to stress with people. If you're in a high tax year, it
Mhm.
might not be a good time to do Roth contributions. So I'll give you a couple examples of those. That is, you go sell a business. You've been running a business for 20 years. You sell the business in 2026. That is probably not a good year to
Mhm.
be doing a Roth contribution. Why? Because that's probably the highest taxes you will ever pay in any year. Maybe the next year is a great Roth year or the year after, but unlikely that year. The other thing could be that you're in a sales job and you had
Mhm.
a great sales year. You are probably looking for a deduction, meaning a traditional 401k or traditional IRA to bring down your taxes in that year because you had a high income year. So when you're looking at Roth versus traditional planning opportunities, it often is are taxes elevated in the current year over what I expect in the future or normally those are not great years to do a Roth. Now, I will bring another caveat here. Sometimes people misconstrue that to think, well, that means if I'm a high income earner, I should not use Roths.
Right.
That is not what we're saying. We're saying if it's an unusually high income year, it's not a good time for Roths typically. But if you're somebody who's always going to be in the highest tax bracket, it really doesn't matter because you go back to that original point. You'll end up with the same amount of money if you are always in the same tax bracket, regardless of traditional IRA or a Roth IRA. And in those scenarios, if you think the tax benefits are the same, Roths are better vehicles today. And I'm going to point out two benefits of Roth that don't have to do with how much money or the tax side.
Mhm.
The first one is Roth IRAs are not subject to required minimum distributions in retirement. So once we get to age 73, 75, we do not have to take required distributions out of those. Versus a traditional IRA, we are going to have to take mandatory distributions that the government says you have to distribute this money. And in your mid 70s, it's about 4% of the account per year. And that continues to get higher and higher over time. So a lot of people just want flexibility and
Right.
control there. And then the last piece is if you pass away and you leave a traditional IRA or Roth IRA to your children, a Roth IRA is a superior legacy vehicle
Mhm.
because they can, in that situation, leaving it to your children, they can leave it for 10 years, allow it to grow in value versus traditional IRAs. Most of the time, it'll be about a tenth of it coming out a year. And so the distributions will occur faster and
Right.
the kids will pay taxes on those distributions versus the Roth, the kids will get tax free. So there are two benefits that if everything else is equal, Roths are, under the current laws, better vehicles than a traditional IRA.
And you bring up a good point because maybe age doesn't really come into it either. It's really about income because someone who might be a little bit later in thinking about legacy planning, if they are in a low tax bracket, could do some conversions.
Mhm.
So let's talk a little bit about conversions.
Yeah, so Roth conversions are when we have a traditional IRA and we want to convert that in a given year to a Roth IRA. So if you have $10,000 in a traditional IRA and you're not, and maybe you got let go
Mm.
or you took some time off that year and you have an kind of not really a normal tax year, you just don't have a lot of income that year. It could be a great time to convert a traditional IRA to a Roth. And what that means is we pay taxes on the amount we're converting. So if there's $10,000 in there, we want to convert all 10,000. I'm just going to use that flat 25% again, right? We would owe $2,500 in taxes. Now, you have two choices there. You can either pay the taxes from the account, take 2,500 out, send it to the government, and then you move over $7,500 to the Roth. But here's where planning really comes in. The best thing to do is not that. The best thing to do is to pay that from an outside account. So you're thinking a bank account or a brokerage account where you had some cash sitting there, pay the taxes with that. Because now you actually can send the whole $10,000 over to a Roth. And that's where the planning actually kind of flips the script. Because in that case, we actually have more after tax advantaged money than we did before. Because now we have $10,000 after tax that gets to grow tax free for the rest of our lives. That becomes a very powerful planning strategy. We often use that right after people retire when their income drops. Maybe you're 63, and we'll do some conversions over a couple years to get more control at a lower tax bracket and move this over to a Roth to enhance that certainty also of like what's going to happen, how much money will I have, and I have this nice time period where maybe my income is not as high as it had been.
Hmm. Something else I wanted to bring up that we touched on in the beginning, but Roth 401k accounts. So there's a little bit more room to contribute there, and we don't have the income limitations. So give us a little bit of background on that.
Correct. So Roth 401k is, if you go back a really long time ago, didn't exist, and then they added that feature. So I see more and more retirement plans now that have opened this up and allow for it, especially the last, I'd say, 2 years, because some new laws were passed where they actually now require catch up contributions
Right.
to be done in Roth 401ks. So most plans have had to solve for this now. So it's likely that you have a Roth feature if you're at a large 401k. Really, they just had to modernize it and get it up to speed. But that's the same contribution limits as a traditional 401k. So you're talking about almost 3 times as much you could contribute each year to a Roth 401k. Now, there's a lot of interesting things about the Roth 401k opportunities, and we don't have enough time to dive into all of them, but you can contribute more there. And as you mentioned, there's none of that modified adjusted gross income limitations. If you are making $10 million a year, you can still fully fund your Roth 401k account, salary, contribute that money over. And now they even allow for employer matching in Roth accounts too. So your employer could match, and you really can then start to accumulate 30 plus $1,000 a year into a Roth account inside of the 401k. And when you retire or leave that job, you can roll that Roth 401k money over to a Roth IRA, and kind of just that's really about tracking and consolidating so you don't have too many accounts all over the place.
Mhm. So, Jamie, you touched on income there. The income limitations don't matter if you're contributing to a Roth 401k,
Mhm.
but talk about ways we can get around the income limitation and get money into a Roth IRA.
Yes, I think we'll try to wrap up on this one and get us closer to the end here. Uh, but if you make a lot of money and you don't have a 401k and you're trying to contribute to a Roth IRA, you might just have too much income. You're making $500,000 a year. You can't make that direct Roth IRA contribution. You can engage in something that the industry in the world has kind of called a backdoor Roth contribution. And so this is using some of what we talked about earlier with conversions. So if you set up an IRA, traditional IRAs do not have income limit phase outs. So we can put after tax money in at any time. So that means we're going to pay the taxes and put it into a traditional IRA. You say, well, why would you do that? There's not a lot of benefit to do that unless you are planning to convert it, but you could then convert that after you fund it. You could put $6,500 in after tax, then convert it to a Roth IRA. Because that whole account then is after tax money, you don't owe any money on the conversion. And now you've been able to put money into a traditional IRA after tax, send it to a Roth IRA, and owe no different in the taxes than if you just were able to put it directly into a Roth. It seems a little weird because you're kind of like, well, why would the government allow this? They actually do allow this. It has been audited from people out there. Now, there's always that concern that you should talk to your tax professional before you do any of these things because it is a two-step rule kind of going around a limit. But generally speaking, this is promoted at almost every major financial institution. I've been through IRS audits where they've looked at this. They have never policed this because both steps are legal. There's nothing illegal about it. But there is a caveat to this one, and it's always an important point to watch out for. If you had a large outstanding IRA with a bunch of money in there, so if you had $1 million that you rolled over from a 401k to an IRA, and then you tried to do this, you'd actually have to prorate or consider that entire $1 million IRA. So then when you did the conversion, reality is, 98% of it is going to be taxable. And so you're really just doing a conversion of, pre-tax money at that point versus this backdoor approach. Now, these rules sound complicated. They are. It's always a good reason to work with financial professionals on this that understand that because there are unique situations that pop up. Conversions could impact other benefits. It could push you to a new tax bracket. It could make you ineligible for certain income-based support programs out there. So you do have to think about the whole picture before you engage in these planning strategies.
Reach out to a professional.
Yes.
It's complicated. Okay, with that, we are going to do some myth busting here. So let's clear up a few common ones, and we'll keep this quick.
Rapid fire myth busting.
How about you start us off, Jamie?
Well, I think one of them is that Roths are always better.
Mm-hmm.
What do you think? Yes or no?
I say no.
Yeah. So we kind of hit on that,
We
right?
did.
But not always better. It's situational.
Mhm.
Myth number 2, if you're a high earner, Roth planning never works for you.
It actually often applies more. It's just indirectly.
Yeah.
We touched on that too.
Yeah. If you don't qualify 1 year, you've missed it forever with a Roth.
No, that's wrong.
Yeah. You should only have a Roth or a traditional. How about that one? One or the other.
No.
Yeah.
You want optionality and flexibility.
Yeah, I actually often recommend people their 401k to do both and actually kind of split up some of their contributions to a Roth and some to their traditional.
More control.
More control. It's also something we call tax diversification in case the rules
Yeah.
and the laws change
Yeah.
in the future. But this was a lot, Kate. I think we covered a huge ground here. As I said early, it's a little bit of a joke when the person said I talked too much about Roths because the rules are complicated. It's so powerful. But end of day, Roths and traditional IRAs and 401ks have to be done inside of a financial plan or a financial vision. You're saving. What's the right thing for you depends on so many different factors. And with Roth versus traditional, it often gets down to this. Is it better to pay taxes today or wait to the future? And I'd say a lot of Americans today do not believe that tax rates are going down in the next 10 or 20 years. And if you believe that tax rates are going to continue to rise over the next 20 years, then you would rather pay taxes today. That is where a Roth can step in and really help out.
Jamie, thanks so much for sharing your thoughts with us today. And thanks to our listeners for listening to another episode of the Planning Perspectives podcast. Be sure to subscribe on your favorite platform, and we will see you next time.
Thank you for listening to the Planning Perspectives podcast. Don't forget to click the follow button to be notified when new episodes are available. Visit our website at www.bmt.com or call us at 833-973-7633. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Investments, not a deposit, not FDIC insured, not insured by any federal government agency, not guaranteed by the bank, may go down in value.